that. So one thing I want to ask specifically is since you increased your position sizing, as since I've been following you from a long time, how do you cope up with again decreasing the position sizing when your meteor probably a loss in a month or something? So how do you manage it to bring it down, and what would be the ideal situation where you again increase the position size? Because sometimes I do feel the VIX is very low and the volatility is like very high. So at the same time, we get hit and we might be a bit scared to enter the same position sizing again. So could you please throw light upon this?
Hi, Ishwar. Thank you for your question. So it comes down to a simple thing, Ishwar. First of all, the increase of position size was staggered. So I was trading X and then I added 20% to that and I added 20%, 20%, so on and so forth. And until I reached max position size. And one thing you have to keep in mind, at the point where I was increasing position size, I was at absolute equity peak. So I was hitting each equity peak, and I was hitting accordingly increasing my position size. Why? Because the period was very conducive. Even though you can say that September, October premiums were very low. In November, the premiums were falling, falling, falling. VIX was falling, but money was being made. The market a lot of the time was pinned, right? So you were making money, so it made sense to take risk. Now, where did I start cutting my position size? As soon as I dropped about 1.5% from the equity peak, instantly started to cut position size. And now I'm back to like absolutely lowest possible position size. And the idea is very simple. If you're doing well, if you're at equity highs, you start increasing position size. You try to maximize what you can make. When you're losing, especially like for the past 2 months, one can say that most VRP systems, be it 920 or delta hedging type systems, they're losing. That's where you have to cut down size. And so quite simply, if I can cut size by half or one third and reach an equity high, then again I will think about increasing position size. It comes down to this: if a period is going well, right, you can take proportionally larger risk. You can try to maximize that. Now as soon as, so for me, most people will say 2% is not a drawdown, but 2% is generally the max drawdown that I try to go for in a year. Maximum it might get pushed to like 2.5, but in the past year I've not seen anything above 2.5% drawdown on an account level. And keeping that in mind, my framework is, look, if you can look at it can be something as simple as, if the past 2 3 weeks you've been doing well and you're finding comfort in running whatever kind of trades you're running, you can push the position size because it's working for you. It's like the trend is in your favor almost, right? The trend of market behavior is in your favor. When it's not, when you reach, let's say I'm saying I don't want to go about 2.5% annual drawdown and I reach something like 1.25 or 1.5, there I have to start cutting size, right? So people will say it'll take longer for you to reach equity high. Good, it's fine. Yeah, I at least it'll give me back confidence that even though I cut down my size by half or one third, I still reached equity high, and that will boost my confidence immensely, right? So that is the problem. If your acceptable drawdown is 5% annually, see, I don't have targets, be it weekly, monthly, annually. I don't have targets. I'll make what I can make, right? Oh, anything is fine, really. But I have anti-drawdown targets. I cannot afford my account to dip. I'm talking only equity, F&O perspective. Equity, I mean, I can't control. If the market falls, I'm not going to sell off my shares. But from F&O, I cannot see, let's say, a drawdown of X. And I take half of X if I'm there already, then that's where you start cutting. Because if this trend of you losing money continues, at least you will lose slower also, right? You will make back slower, but you lose slower also. And as long as you're confident in what you're doing in your approach to the markets, you won't have that problem. So I hope that answers your question.
Yeah, thank you so much.
Yeah, next question. Abhinav Prakashji, your question.
Yep. Hi. Thanks. Ashish, my question is, once you start this adjustment in delta neutral strategy, and after a point you reach towards quite near to your hedge, how you decide whether you want to book the hedge or just close the sell on that side and let the buy hedge as a buy make profit? How to decide on that point? Um, Hope my question is
So
clear.
I don't generally do that.
Okay.
Yeah. So, I mean, that is essentially what you're hoping for is that a big gamma move, you've exited, let's say, a put short leg, and you have a put long, which was your hedge, and you're
Yes.
just hoping that a gamma move happens. That's a discretionary bet, which very, very rarely occurs in my case. Most of the time, I'm not doing. I used to some like a long time back. I used to do stuff of that nature. Now I just don't like how disproportionate it can be. So as I keep adjusting generally, if for example I reach very close to my hedge, then what I'll end up doing is I might actually book the hedge and move the hedge away also. So that's one more thing that you can do. And most of the time, look, when you have a gamma explosion, right? It really doesn't matter if you're on 20 delta, 30 delta, or 10 delta. Like in this morning's move, right? It doesn't matter if you were on let's say you're trading fin nifty, it doesn't matter if you short 20 rupees, 30 rupees, or 10 rupees. It is proportionately going to hit you. So a lot of the time in delta neutral, more than the which strikes you're on, you're also creating a view around IV. You're thinking overall, will the 100-point triangle lose? Overall, will the 200-point triangle lose or gain? I mean, ignore the delta part, right? You can also just track the at the money, and you're placing a bet on whether the at the money is going to rise or fall. Right. So my when at the money spiked from 220 to about 250, I thought that was a pretty good entry. I entered there. I got kicked out by the time it became 265. My position was down about 7-8 points, and then the next thing I know, the at the money shot up all the way till 320. So as far as there are some people who probably make killer profit. Like yesterday, if somebody had cut their short put leg and let the long put leg go, because hedges, I think 4 or 5 rupees hedges also went up till 400, 500, they would have made a killer money. But that's not something I trade. So I don't do that.
So basically, relying
I mean, more
on
specifically.
yeah, relying on the long hedge is not a great idea.
No, it might be a great idea in certain setups. Don't take it from me. It's just that I don't do
Got it. Got it.
such kind of trades. They're extremely low probability, but they can be amazing risk reward. I had posted a trade on expiry. I don't know if you'd seen. I had posted a trade where I said you buy the 4 rupee put option and you sell, which was 100 points out of the money, 17,800, and you sell to 18,400 call options on Nifty, which was two and a half, two and a half. So it's a net credit trade, but potentially will give you the same kind of trade that you're looking for, where you see a hedge explode, right? It's a 1 rupee credit trade. So yeah, but otherwise I don't do those. It's not my standard. I don't try to look for those setups.
Thanks, sir.
Okay. Next
Yeah.
question. Prasanna ji का सवाल.
Hi, Bandi. I have two questions. Primarily considering the market behavior in the recent months, with the SL hunting moves and all, how do you try to keep the SL in such a spike and high volatile environment? That is my first question. And the second question is on many times I see your post regarding the premium behavior. So, is it based on the ATM straddle that you consider, to say that it is on the expensive side or the premium is on the rising side? How do you go about measuring the overall premium? These are my two questions. Thank you.
Hi, bro. Am I audible? Hello.
Yes, you're audible,
Yeah,
Shreyas.
you are audible.
Oh, okay. So, couple of things. Right? So, first of all, is this current volatility period that we're seeing? It's a part of volatility cycle, right? So, we had this immense crush in volatility all the way till the end of November, and now we're just seeing a mean reversion of that, which is why it doesn't matter if your stops are small or stops are big. When you see the kind of spikes that we've been seeing recently, when Bank Nifty falls 1,000 points or 1,200 points, it doesn't matter. That stop has to hit. So your entire idea and approach to this market, where now right now you're seeing a volatility expansion cycle. From the midway of December, we have been seeing volatility expansion, and if you think about it, a lot of it is also common sense with the budget coming up and we being at historically low volatility. By the way, you will see that cycle. So the it's not about how do you keep stop loss? How not keep stop loss? It's about you have to position yourself where the risk on the table that you're willing to put. Because if you have a short volatility system and volatility is rising and it's in a cycle where it will probably continue to rise until the budget at least, you have to put very little money on the table. You can't come and say, morning, I took full position strangle on this thing and then I lost money. It doesn't matter where your stop loss is, it's bound to hit. So the thought process has to be when you know that the tide is not in your favor, you don't try to push a big boat. It's like don't try to be like I have to make money right now. The tide is not in your favor. Don't force the trade. So that's one thing. Secondly, about the at the money. Look, there are many ways you can track volatility. Some people use IV to track volatility. Some people use premiums. And I prefer using premiums because premium is actually traded and you get to have a good understanding of how the IV is behaving from the premium. And instead of tracking what is 200 points triangle doing, what is 300 points triangle doing, what is 500 points triangle, what is 1000 points triangle doing, at the money can be used effectively as a measure to measure all other spreads instead of tracking 10 different spreads, right, from at the money plus 500 minus 500, you can just track at the money and that can be used as a proxy. Now, when, for example, I had posted that we're seeing 300 rupees with 10 days to go for the budget on Nifty at the money, which was 18,200 at that point of time. What I mean to say is, if you look at last year it was 450 plus, right? The previous year to that, it was 450 plus. So now it's trading at 300, which is historically the lowest it has been going into the budget. You're comparing one at the money versus another at the money at a similar period of time and trying to arrive at is this a good price or not to price in an event's risk. Secondly, also from a day-to-day basis, like for example, where FinNifty straddle opens on Friday. Today, I thought 250 was good. When it spiked to 250, if you compare versus the last 6-7 weeks, you have never seen higher than 250 on FinNifty at the money. But at the same time, it has also gone to 320. Right. So where do you come up with, okay, this is good, this is not good? You have an understanding of previously what was it? Previous Friday, what was the thing? If you're trading Nifty on a Wednesday, you think about, okay, last few weeks, Wednesday, what has Nifty at the money opened? So if it is opened higher than the average, you can assume that the risk reward is good. So you can have a, fairly, like, I don't know, you can say you want to have a 10-point stop and enter at that point. Versus if it is lower, then you don't really have the best risk to reward. So at the money is used as a proxy for understanding how much Vega potential gain is there in a position by studying it either intraday at the money behavior or 2-3 days at the money behavior or the same day previous week at the money behavior. You can understand, is it a good trade or not? Is it highly likely to make me money? Not very likely to make me money? That's what you arrive at from studying at the money. So that's it. Also, one more thing, we're getting highly trading related questions. If anyone has investing related questions, also those work as well. Yeah.
Yeah,
Thanks for your answer, Ramesh. Thank you.
Nandanji, your question.
Yeah, yeah. Hi, Shreyas. Thank you for connecting the session on such a day where the stop losses are hitting on both sides and the algos are having issues and everything. So it was really like a light in a tunnel. So I was just going through your Twitter space and just trying to understand what are the trades you took today, and I was not able to get it. So if you can just give a small gist on that, like like how did it go and what did it do, just for my learning, it will be good. Thank you.
Well, look, so my approach to markets currently in this current environment is I will position size fairly small. In the morning, I saw that FinNifty at the money IV as well as overall IV shot up, and I took a position where I had about 25 rupees short on the put and 20 rupees short on the call, trying to play for mean reversion. Backfired immediately. I lost about 8 points, and I closed it there. Look, one more issue that we're seeing very frequently, and you're seeing this issue more on FinNifty and Bank Nifty, is that you see a huge amount of congestion. Many people are taking identical positions. They have identical stop losses. And you see this. So I like to describe this as like, imagine a football stadium with lakhs and lakhs of people inside, and there's only one exit, right? So the impact cost also, I mean, forget the fact that we're in a volatility expansion cycle. The impact cost is at an all-time high where everyone wants to get out at the same time. You either pay that premium to get out, which is you know for a fact that it might be like much cheaper, maybe 10 rupees cheaper in the next 2 minutes, but you can't afford to take that risk because we've lately seen moves where 5 rupees options are going to 500 plus, and that has happened 3 times in the past 2 months, right? It's not a, so you can't afford to be like, I will wait for the panic to cool off, especially if you're an intraday trader. And we are fairly leveraged, right? Even if you don't use hedging benefit, we are fairly leveraged at 5x notional. So you have to, I mean, there's nothing you can do to avoid it. Could you just repeat a part of your question? I think I glanced over it.
No, I just wanted to know what did you do today? Like you were selling
Yeah,
normally.
yeah.
Yeah, just to understand. And what's the current position? I think probably you have booked your loss. I think. Am I right? Or
Oh
did I
yeah.
just?
Oh yeah. Oh yeah, yeah. So my risk appetite lately is like non-expiry days is like 0.2%, the
Okay, okay,
0.3%, stuff like
okay,
that. So
okay.
yeah, it's because the cycle, as I said, the tide is not in your favor. You cannot push something, and generally, look, market volatility never stays the same for more than 3 4 months at a stretch. So the tide at some point will come back in your favor. You just have to pivot accordingly. You just have to increase and decrease your risk appetite based on, I mean, anyone can tell you that for the past 2 months, if you're non-directional, it's been not so good. If nothing else, you've not made any money. Maybe very little from trading properly. But there was no great opportunity to make money for non-directional folks in the past 2 months. So you ease off. But yeah, that's about, my trade was fairly straightforward. It was a gap fill kind of a trade, and it basically backfired, and that was the end of it. Yeah.
Yeah, thanks for clarifying. And I'll hope to see more sessions till the budget, because I think a lot of such moves can happen, which will probably test all our emotions and systems and everything. Yeah,
My honest advice to everyone who is actively day trading is, most of the time you'll be doing yourself a big favor if you just don't trade till the budget. And I've been saying this for a while now. Just it is too random, too unpredictable, and most of the time a bad a risk proposition to be short gamma when you have a budget coming up, and you're also seeing historically the lowest pricing of risk that we've seen. So most people will be doing themselves a favor if you just don't trade till the budget. So that's there. Yeah.
yeah. Just wanted to test the water. So probably just to add, it's good if you can either you don't trade or trade with the least quantity which is possible, just to test the water with your stop loss and risk in place. Yeah. Thank you.
Yeah. Yeah.
Yeah.
Thank you.
Pukar Mehta, your question. Pukar Mehta, your question. I think he's not there. Sujan, your question.
Yes, how are you?
Yeah, I'm
Am I
fine.
audible?
Yeah, you're audible. Go ahead with your
Yeah.
question.
Uh, my question is two questions. Both are related to one another. As Shreyas mentioned before, he's going to cut down his positions when drawdown reaches to 1.2%, and his maximum drawdown per year is 2.5. Suppose it reaches to 2.5, what is his action? And second question is, when he is going to increase his positions, if he crosses to equity high curve, or is there a limitation between previous high? Is it like that? That's it. Thank you.
Shreyas, your take on it.
So see, it's very straightforward. I have a minimum position size and a maximum position size. I'm not going to trade below a minimum position size because it's not worth my time, and I can't trade beyond a maximum position size because my account will not allow it. So if I do reach 2.5%, what I'll then do is, instead of trading set up, let's say I have a checklist, hypothetical checklist of 5 things, right? If 5 on 5, it means very attractive. If 1 on 5 means least attractive. So if I've reached a point where I'm at my maximum allowed drawdown for the year, then I will look for 5 on 5 setups to enter. I will not enter at a point where I think risk reward is okay, or it is fair, or moderately okay. I will wait for it to be very very good, or I will take trades. Like for example, I will no longer trade strangles, and I will make a ratio which has very little credit in it, so that I can just have a position, and I almost, like for example, let me look at the option chain right now. All right, so like right now, if you were to okay, IVs have cooled off, but if you were to buy like a 10 rupees put option on Bank Nifty, and sell five rupees call options, right? Ridiculous positions where you are basically going to somehow make money, stuff like that. So I will basically, the understanding has to be very straightforward. If I'm reaching drawdown levels which I consider I cannot exceed, then I will drastically cut the amount of risk I'm allowed to take in a day. So if I'm saying that I'm on expiries, I'd be willing to push up to 0.5% risk, then at that point, probably won't even allow it to go beyond 0.25. So how the specifics of it, and as far as position size, there's a minimum and there's a maximum. I'll not trade below a certain minimum. I can't cut down beyond this. I might as well skip trading. That's going to be a better this thing, and wait for the right opportunity to enter. The thought process is very simple, man. When you're making money, right, you push size, you push risk. It's okay because you're making money, you're an equity high, you're this thing, you can afford to take that risk. As you start heading lower in the equity curve, that's where you have to start trimming down position or trimming down your risk appetite, however you do it, right? Either lesser number of points in risk or lesser size, so maybe still a moderate amount of points in risk.
I hope your question got answered.
Thank you. Thank you.
Yeah. Kaushik, your question. Kaushik, are you there?
Hey, hi Shreyas. Yeah. Am I audible?
Yeah, you're audible. Go ahead.
Hey, hi Shreyas. This is Kaushik. I was your junior in Diksha almost 10 years ago.
Oh, wow. Okay. Hi.
Yeah, I've been following all your content. Thanks, man. Thanks for all the content that you put out. And my question is, why do traders bifurcate themselves as either non-directional or directional? Like, for example, till last Thursday, the non-directional would have worked very well, but in the last few days, with the Hindenburg report and all the negative sentiment in the market, the probability of you staying directional and making a profit is much more higher than, again, still being non-directional and fighting your positions and adjusting.
Hi, Kaushik. So I'll put this quite simply. The rule around this is you can't be a master of all. Okay. There are some people who can be a master of all, but trading is really about understanding who are you, what are you comfortable with, and it's more about staying in your comfort zone and always managing your mind in such a way that you feel like I am in control of what I'm doing, right? That's what gives confidence to a trader, and they feel that they know exactly what they're doing and they're the master of it. Why do some people do only non-directional even if trend is super clear? And why do some people do only directional, like scalpers, for example, even if it's very clear that the market is not going anywhere? It's because it's not about which game is like, for example, if you're a footballer, right? Like if you're playing a defender, you're going to only play defender. You might be very good at taking shots and being a striker as well, but you'll hone your skills, your entire structure, your preparation, your study around how to play defense properly. So in the market also, we demarcate an area, we demarcate a trading style, we demarcate a certain approach with risk reward as well. And we say that this is my core expertise. I'm going to work only on this. So the question is not about what is good. It's not about whether directional make money or non-directional make money, or scalpers make money, or positional traders make money, futures traders. It's about what gives you comfort. Now, once you've identified what gives you comfort, you're better off sticking to that. It's okay if you have losing phases. It's not that you're like there are some people, obviously it depends person to person, some people who are able to very easily switch between being an option seller, option buyer, trading directional, trading non-directional, finding different setups, either in a discretionary way or having some kind of rule-based way of arriving at that. Great. But for me, I understand that I only know how to trade well in one particular style. If I become a scalper, I'm as good as 7 year back what I was when I first was punching orders in a certain way, because I don't have the experience around it. I hope I'm making myself clear. You find see, the market is an ocean. You can't do everything. You find a small little island, okay, and say, this is my island. I'm going to draw a boundary here. Because if you try and compete with everyone in the market, you're going to lose 100%. Because some other guy has been trading that for longer than you have, has better technology than you, has better execution than you. So you don't try to do all that. You try to say, this is my boundary. What do I know when I come to the market? I'm like, I want to make 10 points. If I can give up 5 points, that's fine. I'll give five, I'll make 10. I don't care what anybody else is doing. Somebody might have caught a 500 point fall, 1,000 point fall on Bank Nifty yeah, on Wednesday. But I know I just didn't lose any money. As non-directional trader, for me, I'm like, bro, that's win for me, right? So yeah, that's about it. You don't think of it from what is making money, what is not making money. Think of it from what gives you comfort, what can you build around, what gives you confidence to trade, and trade only those setups. If you can do multiple, great. If you can't do, identify who you are. I'm the kind of guy who cannot do multiple. I will only do what I do. I'll stay inside my boundary. I don't want to mess with other people. They're bigger than me. So that's my take on that question. Yeah.
Got it. Okay. Thank you.
Yeah, Akshay, your question.
Hi, I have a question that currently market was trading at 17,700, and what would be your next level of purchase of equity or ETF, and how you are choosing that for your investments? And
Yeah. So actually,
okay,
I ended up buying Nifty Beats today. I bought a small tranche, a very small tranche, simply because, pre-budget, whatnot. The 200 DMA is something around 17,200, 17,300. Generally, my sizable purchase, at this point, I'm around 30% liquid
okay,
and 70% equity. My idea will be that about out of that 30% liquid, if from 200 DMA, which is 17,200, let's say, we fall even about 10%, then half of my liquid should be converted into equity by then. So you divide that however you want. But basically, I start buying properly at 200 DMA, and it's either ETFs or it is like market leader stocks, number one, number two, stuff like Bajaj Finance, HDFC Bank, TCS, that kind of stuff. And I will buy either based on those stocks levels, or I will quite simply, majority of my investments are in ETFs. I will buy the ETFs in such a way that about 15% of my, which is 50% of my overall liquid at this point, gets converted within 10% of a fall from 17 to 1. So if we do go to, hypothetically, let's work with hypothetical numbers. If we do go to a level which is something like, let's say, 16,500, 16,000, I'm not saying we will go, don't get it that way. I will slowly keep adding cash. I will keep infusing money. It's like, look, trader, investor, always two different mindset. Investor, you always want to buy cheap, but at the same time, you want to never overcome it. The thing is, you don't buy something saying that, okay, market is dipped, I'm going to overcome it, I'm going to put a lot of capital in advance. You buy in tranches. You buy slowly. And how does my cash get replenished? My cash gets replenished from my trading. In somebody else's case, it can be their cash gets replenished from their salary, right?
yeah,
They accumulate cash through their salary, and so think of trading income as my salary. Okay, so I'm not going to put it in at any point. I might put periodically, or I might put at certain levels, right? And I will always have cash left over. The thing is to always have cash left over that you can infuse into market. Don't overcome it, right? So that's my trading approach is not rocket science. It's always been the same. I've posted about it a hell a lot of times at the points when I was buying, that I'm buying this, I'm buying that. After we break out about the 200 DMA, that's where all the momentum guys buy, right? All momentum guys who are, and I consider momentum investing as nothing but trading. I don't consider them like long-term investors. I mean, in some case they become, and they also catch amazing stuff. But I'm more on the value investor side. I will wait for a time when there's blood in the market, and that's when I will commit capital. So that's my approach to it.
okay. I have one more question that if you are having an X amount of money, and what instruments you will invest and how you are choosing that ratios.
See, if you really want a no nonsense answer, um, picking stocks is something people do to please their mind. Okay, to feel like, oh look, I picked these stocks. So think of that almost as an entertainment. If you want to pick stocks, right, especially mid cap and small cap stocks, do it with a very small portion of your portfolio, like not more than overall 5% of your portfolio. A majority of your portfolio, ideally, if the idea is to make money, make wealth, should be in low cost ETFs like Nifty Bs, right? Or bank Bs, and basically low cost index exposure is what you need to go for. That is what creates wealth. You always buy the overall market. Yes, some people will say, I bought Tata Motors at 50, I bought it at 60. Great, that's fine. But in my way, I don't think that is like a sustainable long-term investing approach. Always think of buying the overall market, buying junior Bs, Nifty Bs. This is the best way to invest, and charges also make a big difference. So I would not suggest mutual funds. I would always suggest stick to low-cost ETFs. And when the market is falling, don't overcommit capital. Slowly commit little by little, and keep adding to that, one, over time, and two, based on levels, right? So based on and if you do spend a lot of time in the market and you're seeing that, okay, TCS is heavily oversold, Reliance is heavily oversold. Let's say a blue chip of a blue chip shop, like something like Bajaj Finance, right? Is down X% from its high, and it's a good risk. Even then, don't overcome it. Even if Bajaj Finance is down 30% from recent highs, don't overcome it. It can go down 40% also from recent highs. So slowly incorporate. And so whenever I buy blue chip stocks, overall, one single stock will never be more than about 1.5% of portfolio. This is excluding ETFs, 1.5, 2%, like that. And see, it's not rocket science. Just buy market leader number one, market leader number two, market leader number three when you're committing serious capital. If you're doing it for punting, it's like somebody's like, okay, Paytm has fallen so much, maybe it bounces. Put 0.5%, put 1%, and say that, yeah, I'll exit it probably if it dips another. So that's more trading. You're trading in the cash market, but those are not investments, right? I would never consider a company like Zomato or a Paytm as a serious investment. I mean, many people might disagree with me, but I think serious investments always happen through low cost index exposure. That's what you should go for. Everything else is just to please your mind. Look, you might get lucky and beat the market by investing in some mid cap, small cap, which gives you like 200, 300x. I have small caps that have given me 20, 30x, but my exposure is very little to them. And I do that almost for a way of, it's like a intellectual pursuit. You want to feel like you've done something great. But at the same time, I have small caps and micro caps, which are down 90%. So do that with a small portion of your portfolio. Don't mess with wealth creation. Only happens in low cost ETFs. So that's my take on it. Yeah.
Hope your question got answered.
Hello, Bandi Shreyas, sir. Sir, good
Yes.
morning. I just want to know that in this call, what sector you may like to invest more and more for next 2 to 3 years, like that. At least two
So
sector you do like mostly.
okay, so see, once again, so it comes down to investment philosophy. I don't do, sometimes if one sector is heavily oversold, which is not the case right now, I might, like, for example, if IT is heavily oversold or banking is heavily oversold, I might narrow in on that and say that, okay, here maybe I want to take more exposure, but otherwise I don't do that. Right now, I don't think there's any particular sector that I have a view on. And I also don't keep views for 2 years, 3 years. So I have this thing that I buy with the intention that unless something, and especially since I'm buying ETFs, I will not be selling ETFs. I will never sell my ETFs. I'm bullish on the India story. And if nothing else, simply inflation alone. Just think about it. A country that has 5, 6, 7% inflation, simply because of that, the market has to go up, because as prices go up, so will the company's revenues, so will be their EBITDA, and so will be the share price. So I don't have any view on anything for 2, 3 years. I don't have any such thing. And as far as sectoral investing, it's mostly if I find that one sector is heavily oversold, I might add some allocation there. Like, for example, if I think that IT is extremely oversold, which it is not at this point, right? Then I would say, okay, let me get some more exposure here. But otherwise, I don't invest for 2, 3 years. I invest with the idea that this is with me. And with stocks also, when I'm investing stock specific, I invest to hold it for a lifetime, unless it is at a point where fundamentally something has changed, like promoters and all. Like, let me give you an example of a very dirty company. Okay, Vedanta is a very dirty company. Why? Because the management always tries to steal money from shareholders. They do not give shareholders their due. The dividends that they receive, like for example, let's say from Hindustan Zinc Extra, they don't pass on that dividend to Vedanta shareholders. They try to buy out the entire company and delist it at a terrible, terrible price. Trying to basically take the company private at a terrible price, and all the investors who've been there for so long deny them of the value unlocking. So I will not invest in that company because the promoter is just a dirty guy. Like previously, I didn't know that the promoter is like that, and that's why I was probably invested. So I'll exit my investment there. But this 2 year, 3 year horizon and all, no, I don't have any views around those. I my investments are, I plan for them to make me money through dividends and capital appreciation for as long as I live. I don't see any reason why I sell, because it's not goal based investing. And this goal based investing also, I'm not a big fan of the thought process. I think the mutual fund industry conveniently built it as a way of attracting people. But the idea should be, look, I have my money in a place, in a good company that's making me money, both in terms of dividends and as well as growing in capital. So that's my take. Maybe there are some people who have a very structured way of coming up with a view of, okay, next 2 years maybe commodities will do well, this will do well, that will do. I don't have anything like that. Mine very no nonsense. I want diverse exposure. I want steady but proper wealth creation. Yeah.
Shreyas, Himanshu this side.
Hi there.
I hope I'm audible. Yeah. So actually, I'm a system trader and pretty new. Okay, in the system trading thing. I just started last September. Okay, and right now, I am a salaried person, and all my expenses are covered with the salary. Okay. So I have like two systems at my disposal. One is like 1% drawdown system with 24% annual return. Another one is 5% drawdown with 70% annual return. Okay, so the thing is, I started with the 5% and 70% thing, and I started in September, and September, October, November went very well, and then December came where I hit the maximum drawdown. I got scared and I switched to that 1% drawdown system. As soon as I switched to that 1% drawdown system, that 5% covered the drawdown in like 20 days. Okay. So what would you do in this scenario? Like, which first of all, which system would you use? Would you like accept or start doing that system if you are a salaried person and all your expenses are covered by the with the salary?
Hi. So couple of things here. Okay. So firstly, I'm not fully systematic, but I'm actually not even. So I don't qualify as system trader. But I'll put it this way: if you have, everyone's risk appetite is different, right? So you're saying you're a salaried person, so you don't need to take out money from your trading account. Great. So that means that your risk appetite is relatively higher. It's not about what I would do. See, that's why I keep coming back to this. It's about trading is very personal. You have met the max drawdown and you've cut risk. Good behavior. I agree with that. Great. Now, I would do the exact same thing. Now, as you are slowly recovering from your drawdown and heading back towards equity high, you can maybe come up with a balance. I don't know if it's just you have to go either only 1% or only the 5% type style, or you can sort of have a balance between the two. Arrive at what risk level is comfortable for you, right? It's different for all. For somebody looking at mark to market switch 30,000 or 50,000. Sorry, there's some disturbance. Yeah. For somebody watching a tick of 1 lakh mark to market per tick or like 2 lakh mark to market per tick, they might be comfortable with. But with somebody, they might not be okay with 5,000. So you can't come up with, or even in a percentage basis, somebody might be okay risking 1.5%, 2% in a day, or some people even maybe 2%, 3%, because they're making accordingly 6%, 7%. That's their risk appetite. It's a personal thing. There's no hard and fast. But one thing that you pointed out rightly is, when you're losing money, always start cutting risk. See, there are two kinds of people. Okay, people who cut risk when they're losing money, and people who add risk when they're losing money. The second type, no, will always sort of quickly come back, right? Because most of the time, when you're entering a trade, when you're already losing, essentially averaging the equity curve, let's say, you have a higher chance of bouncing back quicker, but you have an equal chance of falling even faster, right? And that goes up exponentially. So I don't know. You will have to come up with the answer to this yourself. The fact that you're saying that I'm a salaried employed shows that you're saying that I have a relatively larger risk appetite because I'm not dependent on the market for my day-to-day thing. Cool. So you come up with, okay, how much am I willing to lose? How much am I not? And accordingly, that can be done.
Yeah, but the thing is actually that 5% drawdown actually scared me because my salary I had like saved for the past 12 years, and I saw my like initial 5 months salary going into the drawdown. Okay, so that's what scared me, and I'm again planning to switch back to the original one because the
One more
drawdown
thing,
actually.
right? One more thing. Look, I'll tell you what. You know, when you get afraid, when you get scared, when you have not when your position size is too large, don't think just because you have margin you can use it. Okay, you need to earn the right to use the margin that you have. You have saved up over x amount of time. You don't have the right to trade on that margin. If you have saved up over a few years, you have not earned the right to trade on that margin. When you don't, you're saying you just started in September and you're already trading with a substantial portion of your life savings. That would be wrong, and that's why you're feeling afraid also. The better way to do it is, even if you have, let's say, 10 lakhs of margin, trade only with 2 lakhs of it. Right? As you get comfortable with that, as you've seen the ups and downs of that, then move to the next, then move to the next, add size, add size, add size. Fear in markets is always a particular derivative of your position size. If you are overexposed as per your own risk appetite, you will feel fear. So get rid of that aspect. Cut down size. The best way to deal with fear is cut size. When you are looking at half the market of what you were looking at yesterday, both positive and negative, you will feel much more comfortable. You will have time to analyze, okay, what is working, what is not working, should I work with the system or not? Yeah, yeah,
Can I just add one thing, Shreyas, here?
sure.
Yeah, whenever, as a system trader, right, don't ever wait for your max drawdown to reach for you to be cutting size. Let's say on a 50% drawdown, max drawdown hits, let's say if your max drawdown is 5%, on a 2% drawdown, you can easily cut your size by 20% if you really want to. So on every single subsequent drawdowns, you can start cutting your size by 20, 10%, so that by the time your max drawdown hits, your actual drawdown is not as much as a max
Yeah,
drawdown is there,
I understood, Mohit.
right?
But the thing is, actually, in one day, I reached from 2% to 5%. That was the expiry, horrible
Okay.
expiry. So I could not have any control over that, and that's what I got scared. So, but yeah, it's like fairly, Shreyas has answered my question. Thanks to the team.
Mm-hmm.
Sure, bro. Thanks, man.
Yeah. Next question, Yash Chaudhary. Yash, are you there?
हाय हाय बंडी आर यू कंफर्टेबल इन हिंदी
हाँ, bro. Sure. No problem.
हाँ जी मुझे ये जानना है आपसे कि जिस भी कैपिटल से पिछले साल 1.5 साल से मैं आपको फॉलो कर रहा हूँ एंड व्हाट आई सी इज कि आप डिसेंट एंड कंसिस्टेंट प्रॉफिट बना रहे हैं सो आपको क्या लगता है कि किस कैपिटल के आसपास जाके आपको आपके कुछ कोलीग्स की जरूरत पड़ेगी या फिर आपको कुछ एक टीम की जरूरत पड़ेगी या ऑलरेडी यू हैव ए टीम टू ट्रेड विद यू
Hi, bro. So, excellent question. Dekhiye, it's like this, okay? I always look for excuses of how to pull out money. There was a time when I just did not pull out money from my account at all. But for the past almost 2.5 years, consistently, I look at key where can I pull out my money. Look, when my capital was 1/10 of what it is now, I used to take ridiculous risk. Matlab, my day's risk would go up to 5%, 6% at times. I would also try to make in a day 10%. Like that, those are the kind of things I would do when my capital was that size. And I never, I tried my best at that point of time, keep like capital nahi nikalna account se, matlab, this thing. Then as capital kept scaling, and since at the end of the day, I'm an individual and I use some amount of tech to help me with, I don't have any team. It's just me. I try to think of where can I pull out money and put it somewhere else. Can I put it into real estate somewhere? And that's my go-to thing. Where if I can generate a real estate asset which is productive, it generates rent, and on top of that, it might also give capital appreciation. Plus, it's a security. It's a different, unrelated basket which is unrelated to my main business. then that's what I'm looking for now. And in terms of till where will I let the account scale? As of now, as it is, I'm pulling out capital as and when I get the opportunity. On top of that, I think individually with the help of tech, I have a particular number in my mind. So I'm like, I will not be trading with my current existing setup, trading style, and approach to trading. I will not be trading beyond, let's say, 10 crores. Beyond that, every other, all the on the way there also, I will be pulling out money. And when I reach there, that will, unless I have a another thing, like let's say I have somebody else managing my money, sort of like I have a trader who's trading with my money, who's not me, or I have some fully automated way of deploying that capital. I will not be deploying because my current approach can only take up to so much, right? And I, by pushing it beyond that, I will be it is a diseconomies of scale. With my current approach, if I push beyond a certain scale, I will have slippage issues, I will have misexecution issues, I will have so on and so forth. I have the help of software to help me to trade the current size I am, and it will be able to support probably a little more. But beyond that, I will not be looking at this thing. So listen, I'll say this as simply as possible. You can have made any amount of money, okay, in your trading account this year. Financial year, you might be up 100%. Great. Until you pull that money out of your trading account, it is not realized profit. That is my hardcore take on it. As a trader, you need to understand anything can happen. It doesn't matter how foolproof you think you are. It is always think about take the profits out. If you can create an asset with it, you are winning. You are winning. You never, it's like, think of it. Sorry for the language because people will say, why are you comparing to casino? Even if you're an extremely professional player and you're at a casino, until you walk out of the casino with the money in your pocket and you don't go back in with that money, it is not your money. Take it from me. So always think about this. Infinite scaling is the most biggest bull that has ever been sold when it comes to trading. Yeah, you do ETF investing, wealth creation, so far it'll keep scaling. Great, yeah, sure. Trading, if you can return X% on so much, you will not be able to return even like 1/10 of that if your capital is 20 or 30 times, right? So my honest take on this is, as your capital scales, right, both for your confidence as well as for the correct thing to do, is think about how do you diversify from the market. Yes, you have market investments, great, and we have the huge advantage of, we're the only business in the country where our working capital is free. If you have any other business, let's say you run a services business, you want to, let's say, have a working capital account for, let's you need money to do the processes or deliver the service before you receive payment. You might pledge your house or something, bank will give you at 8%, 9%, 10%. But still, that's a OD account or a cash credit account on which you're paying interest. We traders, we get our margin for free. Boss, if I switched off my account today and didn't trade for the next, let's say, 5 years, I come back, there's a good chance my account will give me essentially what the market has gone up by. I'm not losing anything. I either have Bharat bond, or I have liquid Bs, or I have a Nifty allocation, right? So it is essentially, margin is free working capital, right? So we have all those advantages. And my take would be, don't get into that loop of I will make my this money into this, and then on that I'll get another 10%, then I'll get another 10%, and by the next every month I'll keep getting 10%, and I will have X amount of crores by the time it's 10 years from now. Don't get into that delusion. Okay, so that's my take on it, bro.
Thank
Yeah.
you. In the continuation, I would like to ask you one thing, because trading is your core competency. I believe that, at least. Uh, so, आपको ऐसा नहीं लगता कि you should have 2 3 guys in your guidance for your future, like 2 years down or 3 years down, जो थोड़ा बहुत बेंडी का माइंड को रीड करके उस हिसाब से उसी स्टाइल में ट्रेडिंग कर पाए, एंड दे कैन बी योर कोर टीम इन फ्यूचर, बिकॉज ये कॉम्पिटेंसी रहनी है ट्रेडिंग तो आपकी.
I have had a lot of friends who have asked me similar question as to why don't you look at a dealer? Why don't you look at cultivating some traders along with you? And इसमें भी the answer is personality. देखो, अगर मैंने order punch किया और मेरा loss हुआ है, I'll be fine with it. अगर किसी और करता है, मेरे से नहीं होगा. इसलिए I will use technology that helps me. Like for example, as I trade larger size, and obviously order punching itself is one headache. See, as you keep scaling, the biggest problem you have is, how do you get the money in and out? Matlab, by the time you get into your position or get out of your position, the impact cost of that alone will be quite large. So,
Very
but
true.
it doesn't. But मेरे को fit. So, there's some noise, guys. Huh. So, so my it doesn't. I don't know. I'm just not comfortable with somebody else managing my money. So, what is my solution? I have to. There is some clapping noise, bro. Yeah. So I just need technology to help me trade better as an individual. But maybe down the line, I don't know. Maybe at this point, I have no such intention of grooming somebody to do that. Yeah.
या
Thanks, Bandy. Thank you.
Yeah.
संदीप यादव आपका सवाल.
Yeah, hi, Shreya Bandi. Nice to hear your voice after a long time. Do keep on hosting such kind of spaces. It helps everyone actually. Okay, the question is, given the scenario that we are in right now, isn't it better that what is your take on IT and pharma? Don't they look lucrative enough? And what is your take on Adani fiasco? And when are you planning to post your YouTube videos? Thank you.
Hi, bro. So, couple of things. So, YouTube, I'm more or less. See, I started the YouTube videos with certain intention. I achieved that intention, and what I feel like is now when I started, right. So from then, my capital grew by quite a bit, and as it continues to grow, I felt it's too much of a distraction because I constantly felt that I had some point to prove, and that was acting as a hindrance, and because of which I decided, I'm not going to do it regularly. If ever I want to make a video about something, not that I won't make, but yeah, I'm done with that story. That is done and dusted. But yeah, so the next part, as far as sector specific, look, I don't know. I'm not studied it in depth, so me giving you an answer on how attractive IT or pharma right now is going to be a little disingenuous. Right now, the market, as far as pricing, I would say that it is close to pretty. Okay, how do I come up with fair pricing? Okay, fair pricing very simple. You take any moving average. You take past 1 year moving average. Okay, 365 moving average of daily time frame. You see what is the average price that somebody bought at in the last 365 days. Now, if you're buying anywhere close to that, I think that is fair price. That's how I come up with fair price. And with respect to what's happening with Adani, look, if you just search for the term Adani in my profile, you'll know what I felt about Adani the entire time. Adani is in a bubble. There's no doubt about it. It is, even if you buy Adani and it becomes the most amazing company ever, if you're buying something at 600, 700, 800,000 times earnings, boss, you're not going to make money. As purely from an investor perspective, I had never bought a single Adani share in my life, and I will never. And I'm very unfortunate that it became part of Nifty, and now my Nifty Bs are taking a hit because of Adani. It's see, I'll tell you what. All businesses operate on a model that once their shares are listed, they will collateralize that, raise funds, and use that for growth. But Adani has put that on steroids. Adani, I made a video about Adani. It's available sometime back in terms of how their cycle works. They are, forget them being over leveraged and having too much debt. Their valuations just are senseless. So there are people who come up with reasons as to why 1000 PE makes sense, but for in my book, it never will. And please, these are not companies like, when Fang at least was blowing up, and you look at, okay, their businesses are hugely scalable. So you take Facebook, Netflix, Amazon, they're hugely scalable businesses, and they can eventually turn around huge profits. These are all utilities. You're building roads, you're building airports, infrastructure, you're into mining, and you're pricing yourself as the number one growth stock in the world. So my take on Adani is, listen, at the same time people say, okay, why don't you short Adani? Listen, I'm not an idiot. I will not mess with something that's not my core competency. I don't know how long it might stay where it is. I don't know if see, the thing about free float is when there's a lack of free float and you build up a huge amount of short positions, those shorts can get equally killed. So I'm not into the business of betting on these things. I don't know what will happen to Adani. I'm not going to take short position. I'm not going to take long position. I'm just going to ignore it. It is outside my four walls. My competency is very little. I think it's crazy overvalued, but I'm not going to go take my entire account and short Adani with it. Right? Because it's capable of moving up 30% in a day. It is. That's the nature of how that stock is. So my best advice on Adani is pretend it doesn't exist. Sometime back I was thinking, should I short an equal amount of Adani as to what I'm holding in my ETFs. So at least I can be protected against that or something. But that was just for just for thought process and all. But yeah, just ignoring Adani is probably the best bet. Don't trade things that you don't understand, right? And even if you understand it and it's unpredictable as hell, don't trade it. That's my take on it.
100% agreed. But do keep on posting your YouTube videos. They help people a lot actually, and keep
Yeah,
on.
whenever I have something to say, whenever I have something to say, I'll either tweet about it or post on YouTube. Yeah, something like that.
And do host spaces like this. Why you only host only one space like this in the middle of somewhere?
We'll try to make it
Absolutely.
on weekends
Yeah, actually,
if
yeah.
there's
At least
time
keep
for
one
me.
or 2 days, like in a week, so that we know okay, we can remove time on that particular day. Today,
If
I just happened to
Maybe not
see.
a week, but I think maybe yeah, this was just impromptu,
Today,
but
I
maybe once a month or
came.
something.
Yeah,
Hello.
today I accidentally came across actually. Yeah, yeah, thank you again.
yeah, Arpit,
Thank you, bro.
your question.
Yeah, hi. Can I ask?
Yes, bro.
Hello.
Please go ahead.
Shreyas sir, can I ask now?
Yeah, bro. Please go ahead.
Sir, I actually my question was different, but when I listen you, I reframe my question. I mean, past 20 minutes, you said that earlier you used to take so much of risk, and you used to earn 10% a day. Also, I just want to know how you shifted your psychology or how you built that discipline, because that is one of the most toughest part in trading. So, can you please tell us something in detail about it?
Look, it's an organic process. It doesn't happen overnight. And when I used to take 10% risk, 5% risk in a day, also, I was disciplined only, in my opinion. It's just that my risk reward was higher, and with a smaller capital, it was within my risk appetite to do that. But as the capital keeps growing, you have to keep pivoting. So when your capital grows, you have to adapt your expectations around it, your psychology, your execution, and even the system that you trade. Like, for example, scalpers who trade, right? They only trade with, at any point there'll be long premium of maybe 10 lakhs, 15 lakhs max. Why don't they trade more? Because this, you just can't execute it. You won't be able to get the same entries. You won't get the same exits. Some systems are just not scalable. So it's not something that happens overnight. Look, and as far as discipline is concerned, make no mistake. In markets, you're either disciplined or you're out. It's just a matter of when. So if you're indisciplined, if you're the kind of guy who's like, I'm looking at 5% loss, now I'll double my position. And then when it comes back only 2.5%, I'll be back to even. It's a ticking time bomb as to when you're going to zero, not if you're going to zero. So that's my only take on it. And as far as how your mindset, your approach, everything changes, it's organic process. As your account scales, as you mature more in the markets, you will automatically have to adapt. It's constantly about adapting. Somebody who's trading a portfolio of let's say 500 crores is not looking at 60-70% returns in a year, man. I mean, he'd be the happiest person in the world if he managed to get like 20 to 25%, 30%, something like that, with a drawdown of under 2%. They would be happiest person in the world. So that's basically where that stands. You will evolve, as the market will force you to evolve as you go through.
Okay, sir. Thank you.
Yeah,
Hi,
Arpit, your question.
Thanks
hi
a lot.
Bandi. Actually, I just wanted to ask, ki, have you ever been to your drawdown phase, and how much percent was your drawdown, and what did you do to overcome your psychology? Like, currently my drawdown phase. I am down around 5-6%. So I am bit annoyed with myself. Like I was up 20, 25, 28% around for the year, and now again I'm back to 18, 17% around, because I had increased my quantity recently and my drawdown began. So I am just skeptical ki how should I deal with it, and could you please guide me with that?
Look, drawdown is part and parcel of trading, be it time drawdown or be it monetary drawdown. It happens to everyone. You just have to learn to deal with it. And you will go through it no matter how many years you've spent in the market. Now, in terms of how to deal with it, very simple. Take breaks. Look, there are two kinds of things. Number one, always focus on where your head is. If you're finding that your head is frustrated, annoyed, irritated, you're feeling, when you sit in the morning at the desk, you're already feeling, Arey yaar, what's going to happen today? Don't trade, dude. Take a break. Go take a week off, take 10 days off. You need to have time to reset your mentality. If you're starting with a negative mindset or a irritated mindset, distracted mindset, don't bother trade. Take breaks. Trade lesser. Wait for higher, better entries. Right? Don't take random entries. Wait, try and see that okay, this is one of the best entries. Wait the entire day. If you don't get an entry, don't trade. Now you have to build into that, and that's what you do. You just have to deal with it. Different people have different ways, but most of the time the thing that works is it's always the same answer. Take breaks, cut size, reduce position size, reduce the risk appetite. It's all you can do. What else can you do? You're in drawdown, you're in drawdown. That's it.
Thank you.
Yeah.
Yeah,
Hi Shreyas, this is Badri here.
yeah, Badrinath.
Hello. Yeah, Shreyas.
Badrinath.
My question is, on a trending day, let's say, would you be content by the end of the day by firefighting the market and being in the no profit no loss zone, or would you bring some amount of rationality to your trades and take be tempted to take directional trades? Because it is easy to by the end of the day we can say, I mean, on a trending day like this I still ended up being in no loss. But is it rational that on a day when you have the scope to make maximum profit, you still did not make any profit there?
Look, me being happy or irritated with the day completely depends on, did I do something that is characteristic of me or something that is uncharacteristic of me? If I did something that's uncharacteristic of me or suddenly going long put option at a point where I otherwise would not have, and that's not something I do normally, then I would not be happy with it because I did something that is uncharacteristic of me, that is unplanned. Now, if I had a proper plan around it, I would be fairly happy, even if I lost money. So it comes down to this. The reason why traders always have anxiety is because they don't have confidence that what I'm doing, is it sustainable? Can I do this for the rest of my life? And if you make money in something that you feel inside you've done wrong, you will not be happy anyway because you feel like this is not sustainable. I cannot make money like this over a long period of time. Right? I did something uncharacteristic. I still made money. Okay, fine. Maybe a little happy about the money, but you don't really get that joy of, oh wow, okay, this is. It won't give me that elation. So, and you have to also kind of condition yourself that look, when you look back, you always know what are the objectively correct decisions that you made and objectively wrong decisions that you made. I'm not talking about the profitable decisions and the loss making decisions. I'm talking at that point of time, was it characteristic of you to take that trade or to be in that trade? The answer is yes. Even if you make a loss, there's nothing to worry. Like, I don't mind taking losses when I know that I did everything more or less how I do things always. Today was my day to lose. Like today, for example, okay, it was fine. 220 rupees, 218 rupees, Fin Nifty started close on Wednesday. Today it is shot up to 250. I'm taking entry. I'm happy with it. I've exited at 260. I feel like, okay, damn, okay. When I exited, I thought, okay, I'll probably exit at the worst mark to market. From then the market will improve, but shit, whatever. So I fine, I exited. It shot up to 320. I'm even more happy. I did correct decision as per my characteristic thinking of this is how I approach the market. I made a loss, yes, but I didn't do anything that I particularly think was wrong. So I will not be sad about it. And this is a conditioning framework that every trader has to build themselves into. The moment you do something uncharacteristic, you are doing little bit borderline gambling. You are sort of but saying that, this is not something I do, but I just feel today. And when people say conviction tha, main pakad ke raha and all of that is nothing but people just getting lucky. The majority of people who don't cut their positions when they're losing or cut risk or cut size or de-risk, those are guys whose time is ticking. Like I'm telling you, there are days we've seen recently, right? When Bank Nifty option 5 rupees has gone to 500. Now they say, 500 से और भी कितना जाएगा ऊपर? अभी तो नीचे ही आना है. Yeah, it is closed at 200. No, if it gone 1500, then you have to always think about it from, is this a disciplined and appropriate and characteristic decision and feel happy about those decisions, even if you've made a loss. No problem.
Each one his own, but how long did it take for you to build this kind of Zen mode wherein you stick to your rules no matter what?
See, look, so my rules are also a little flexible. It's not like my rules are so stringent that I'm like, oh, this thing. My only hardcore rule is how much I can lose. Uh, I don't know. I think there was a point probably when I felt that am I gambling? Am I just getting lucky? And my only way to deal with that was if I cap my risk and I say that no matter what, I won't lose more than this much, then I'm happy. I'm like, I'm willing to give up this much on any day. At the beginning of the day, I'm like 0.5%. I'm willing to give up. I'm willing to give up. I'm happy with that. And I don't know. You just have to do it. See, bro, it's not about do you do it, do you not do it. If you don't do it, you're going to get screwed. So you have to brainwash yourself to feel happy about taking certain losses, to feel bad about taking profits if you've done something wrong. I posted about this some time back, right? So some people sometimes they come out and say, "Oh, today I got punished by the market, made a mistake and got punished." The real truth is those mistakes always happen. It's just that the market doesn't punish every day, but when the market punishes, it punishes heavily, right? So that is, if you get into the habit of, oh, it's okay to make mistakes, it's okay to hold the position longer than I meant to hold, then it's a matter of time. Your time is ticking. So look, I look at this as a business. This is a business that I run. This is not some time pass that I'm doing. This is not some proving to somebody that I can do XYZ. I'm here to generate money, and for that, if it requires me to say that let hell break loose, if I lose this much, I cut my position, you have to stick to it.
Got it. Thanks, Shreyas.
Hello, sir. Hello.
Gaurav, tell me.
Yeah, am I audible?
Yeah, you are audible, but little bit noise coming from your end.
Yeah. Sorry for I was in office, so sorry for that. Okay, sir. My question is that, sir, I am doing non-directional trading as like you, the straddles or spangles from the long 6 or 7 months. I am consistently making money. Most of the days 1.1% to 1.5% it is ranging. I am selling 10 rupees option on Bank Nifty on expiry day and adjusting according to it. Now I learned that I can make money in this kind of trading setup. So I want to know how can I increase my ROI, sir? Because 2% is not 2% month is not that much great ROI. So please help me regarding that. How can I increase my ROI?
Look, the answer is pretty straightforward. To increase your ROI, you either increase the premium in your position, or you take more leverage. There are different ways to take leverage. So on and so forth. Like there are prop tests that give leverage, so on and so forth. I would never recommend doing any of that. And you can also like hedging benefit. I wouldn't comment on this because I don't trade for ROI. I like my honest opinion is in my trading style, I'll take what I can get. If it is 3% per month, great. If 1 month it's 6%, great. If 1 month it's 2%, great. I maybe it's just me, but I don't really care how much ROI because I think any ROI. I said this before in the space also. Any ROI is free. I'm not putting any money to trade this in my account in terms of cash. Maybe around 10% of my account is in cash, 10 to 15% depends, varies with time. But apart from that, all of the margin I have is free for me. It's invested. It's either coming from investment or it's coming from debt, right? Equity or debt. So I don't focus on RIS. I'm the wrong person to ask this question. If you're regardless of focusing or not, yeah, if you're managing to do 35-40% annually, great. But to be very frank, I don't focus on RI. Market will give what it wants to give. I don't work with targets.
Okay. Thank you, sir, for your information and all the support. Please do your work, and you are doing amazing. Thank you, sir.
Thank you, bro.
Yeah. Next question, Pranav Mewar.
Yeah, hi. Thank you so much for giving me the opportunity. First of all, I'll just like to put some respect on the table. Shreyas, I hold you in very high regard, and thank you for so selflessly being sharing what you always do. Um, Now, my question is more about psychology. Like all the other traders, I had initially lost money. Over time, in the past 4 months, I've been profitable. And the current setup that I use, I'm very confident about it. But the only question that comes to my mind is that is the because I basically use a price action setup that is based on support and resistance. So what constantly there's a thought in my head is that is this the only way that I can make money, in the entire life? So from a person who has not learned from somebody, sir, what would you suggest? Because this is a constant question. Okay, it's working now, what if it does not work for a year? So as a person who's been so experienced, if you could just guide me in explaining that, okay, there are some measures that you need to learn. Maybe you need to learn this as well, or you need to have this in your setup as well, because this is like just one armor in my arsenal. So I just wanted to know your thought on this, and how would you probably deal with my situation? Uh, like I said, currently I'm doing good with the setup, but then again, there's a question in my mind that says that, okay, can you do use this and generate money for the entire lifetime? So that is, and I have no one to ask this question to, which is why I thought of asking this in this space. Thanks a lot. This is my only question.
Hi, Pranav. Thank you. So here's the thing. I give you the answer to that. No setup will work in perpetuity. It's just not going to happen. Okay. What most people do, a lot of people do when they're excuse me, when they're handling large funds, is that they will diversify into multiple setups. Essentially, what is diversifying into multiple setups doing? Only smoothing the equity curve. The idea is always you want a smooth equity curve. So you might have a setup which is highly volatile versus a setup that is highly stable, and you're trying to find the in-between mark of having a smooth equity curve. You never diversify setups to increase ROI. You always, anyone who's diversifying setups and having multiple setups, they're doing it with the idea that between all the setups, my overall account equity curve should be smooth. Now, this anxiety that you're having that my current way of trading, will it continue to make money over long term? Every trader has it. But the entire merit of a trader is as the market changes. Like if you were to compare, if I were to compare how I'm trading today to exactly 1 year back, it would be very different. If you compare that to one more year back, you will not even find head or tail of how is it the same thing. It is technically the same style of trading, but actually there's a lot that is different. So the entire merit of a trader is, and even somebody who's building systems is, as market changes, how aptly, quickly are you able to adapt in order to maintain that smooth equity curve. Now, one straightforward question that many people ask me is, why don't you diversify your setup? The thing is, my equity curve is already very smooth. So I don't need further smoothness in my equity curve. And my other problem with trading multiple setups is, since I trade semi-automated, so I don't do any automation. There's no automation in my trading except for order execution. So when I'm using that, if I have multiple things going on, it distracts me. Yeah, there are some setups that are like very high risk reward setups where you can put potentially 5% of your account and they can generate upwards of 100% return, and sometimes even 200% return, but fairly large drawdown. That's why you allocate a small portion of your account. But if I were to sit and do that, I would get distracted. And I'll tell you one more thing. Even if it's fully automated and I'm seeing the mark to market on the same account screen as my proper trade, I will be distracted by it. So the reason I don't diversify setups is, one, I don't need to smoothen my equity curve. Currently, with my current capital, my setup is able to handle it. The point where I will look to diversify is when my manual and semi-automated version of executing is not able to handle it in a different account where I don't see the mark to market, where I can have somebody else monitor its functioning. I can run that. So there are two aspects around this. and I take it for granted that something that works will not continue to work in perpetuity. It just doesn't work that way because it might work in a cycle, not work in the next cycle. Some work across cycles, but for a certain period of time, and then they don't work after that. This is why, when people put too much emphasis on back testing, I really scratch my head to understand, boss, what are you studying 2018, 2019 data for understanding current market behavior? I think it's completely ludicrous. I mean, there has been such a large structural change in market movement, price movement, with the whole amount of algos that have come in now, that I think all of it is just dead weight. You're just making it look good on paper, saying that. And when people compare 2020, my God, the entire volatility index crashed the entire year. Like COVID gave us, for short wall people, post COVID was just a year and a half of free money, right? And you're comparing all of that to what is happening now, and you're saying it's not working as per back test. So anyway, the idea being, beyond the point, you have to diversify setups because your capital cannot be infused all into one, provided your existing setup is not giving you a smooth equity curve. The reason I don't have multiple is, one, it will mess with my psychology. I don't want to diversify my attention span towards anything else. And two, as it is, my equity curve is smooth, so I don't feel the need to say that, okay, I need to have something to balance it. Like most days, like it is very rarely that I lose more than 0.5% in a day. So that's my equity curve. It is fairly smooth.
Right.
Yeah.
So just one follow-up question to this, Shreyas. So I would just like to, bluntly ask you that, okay, in a month where I know setups are not working, maybe 5 or 6 times in a month, I would get a trade and, the trade would be good. I'm satisfied with it. But most of the time, how would you deal with this? Would you want to learn something more, or since, you're in your zone, you know what you're doing? You just stick to that one setup and just go for it, even if it gives you 4 5 trades a month, you're fine with it. I just wanted to know because like I said, sir, I'm really confident with what I'm doing right now, and I just want to know that, is it the time to learn something new, go somewhere else, or just keep doing this for a year or two and then probably go ahead and learn something else? So just
Listen, you have to always be learning something new, whether you're executing it or not, whether you're trading it or not. You have to always be learning something new, because even the existing system that you have, there might be some kind of tweak that you might have to do to it to stabilize it. And see, the thing is, even if you're doing the same thing again and again, it doesn't mean you're completely ignoring everything else that's happening. So you're always learning and adapting. Look, the only job a trader has to do is learn and adapt, right? So yeah, if you're really happy with your system, great, but never shut off everything else that's happening in the market. Like for example, I don't trade Bank Nifty at all. I've not traded it in the past 2 months plus, but I track Bank Nifty behavior every single day to see what is happening. You have to always know, what is happening, to see is there something there, you know. So yeah, I think it's been over an hour since we started this. We'll probably do another 10 minutes till 12:25, and then we'll
all
call
right,
it.
so I'll just pass. Thank you so much, so that other people can get time. Thanks a lot, and yeah, that's all.
Yeah.
Yeah, we'll take the next question from Vishnu. Vishnu, are you there? He's not there. Grow Capital, your question.
Yeah, actually, my question. Thank you, Shresh. I've been a big fan of yours and the trading strategy, and really appreciate all the hard work and like you put up for the videos initially. This helped me a lot in terms of style and all. So yeah, I really appreciate your hard work. I have one question. In terms of like entering the position, like. At what time you prefer to enter, and how, like uh, like at 9:15 the market starts, so 9:20, 9:15, like I also do kind of have a similar setup. I wanted to understand how, like to take the initial position at what time. uh,
Okay, see, so generally I have a rough idea of what price I want. Okay, so let me give you today's example only. My idea for trading today is that if you open flat with straddle close was 218 on FinNifty as of Wednesday. So I have a rough idea that if it opens above that, then I will want to commit fairly early, right? It's not about 9:15, 9:16, 9:70. It's not like that. Okay. So it's about I'm tracking, I have tick by tick. So I have an Excel sheet which pulls the immediate data. It's giving me tick by tick of what is ATM. It is giving me what is 100 point standard, 200 point, 300 point, 400 point. I have it all on an Excel sheet. Now I'm taking a discretionary call at that point that do I want to commit my full entry here or do I want to commit part and see if it gives me even better to commit the rest, so on and so forth. It's kind of a discretionary decision that at this point I want to commit more. For example, when today the at the money spiked quite a bit, I thought objectively that it's a fair enough point to commit whatever size I was willing to trade for the day. And I committed that capital. Obviously, it backfired still from there. It just kept continuing to go up. So I was pushed out. But at the same time, that's generally how it is. Now, same thing if it had opened at 190, I would not even have entered. I would have said, hell to this. Then I would have seen during the day, is there some opportunity where I can maybe make a ratio or even a strangle, like, from 190, if it spikes back to 220 or something, then that's a good entry. So as far as where do you enter, is it 9:15, 9 say first tick, or you wait for 5-10 minutes? It all depends on my idea of what price do I want. If I want to sell the strangle that closed yesterday, 500 point strangle that closed for, let's say, 60 rupees, if I want to sell it at 60 rupees or higher, if it's at 70 rupees, I'll jump on it. If it's at 50 rupees, I'll wait. So that's the thought process there.
Okay, got it. And like I one more follow-up question, and thank you for that. So like the like you work on Nifty primarily on the strangles. I've seen the videos and all during that time also. Sometimes I wonder like why don't you try the Bank Nifty side of it? Like I understand there's a more volatility, but yeah, like wanted to understand your perspective on that.
There's only two reasons. One, Bank Nifty is far more volatile, as you said. And what happens as part of that volatility is the impact cost on Bank Nifty is extremely high, which means when everybody is exiting on Bank Nifty, you will see insane spikes. You won't see those spikes on Nifty. Like take, for example, any particular day in the past 2-3 months where a Bank Nifty 10 rupee option has gone to 500. That's 50x. But at the same time, on Nifty, you will have seen that let's say you consider a 5 rupee option on Nifty instead of 10, it would have maximum gone to 70, 80, not to 250. Right? And what happens is when you're punching orders on Bank Nifty, you might get 40, 50, 100 points of slippage. I've got 100 points of slippage on Bank Nifty. It is possible. You can get 100 plus points simply because all the liquidity dries out. And one of the main justifications for that is if you see crowding also, right? Crowding, as in I'm talking about the number of people trading as well as the number of algos that are active. They're far more active in Bank Nifty. So I want to stay away from the crowd. I will make less money, no problem. I don't want the headache of saying I tried to cover at 50, but I got a price of 150. I don't want to deal with that because what happens is my first exit might be at 50, but by the time my last exit, my last order goes, on any particular size, I might have covered it at 2 times that. I don't want that. So I stay away from Bank Nifty. I traded Bank Nifty in between. It was very good. And then I just came to the conclusion on one particular day where I dodged a big bullet that I don't want anything to do with Bank Nifty simply because the crowding is too much. Nifty gives you better chances to get out. There are times where you will also be screwed on Nifty, but Nifty gives you better chances to get out and at lower impact cost. The impact cost on Bank Nifty sometimes can be tremendous, and that I don't like. So I just staying away from it.
Okay, thanks, Bandi. Thank you.
Yeah.
Appreciate
Yeah.
it.
Next question, Vishwanath.
Yeah, thanks, Mohit. Shreyas, big fan of your psychology following style and everything, and also Ravi Kumar and Rowdy Trader from the Nifty Bean community. I had a question not related to trading per se, but more inclined towards investment. This is with regards to my parents' retirement portfolio. 85% of their fund is invested in safe assets like real estate, precious metals, and FDs and whatnot. About the rest of the 15%, I wanted to get them some exposure into the equity side of things. So I had an STP sort of model in mind where I would ask them to invest a lump sum initially, and from the next year on, start taking parts of it and move it to safer assets like an RD or debt funds? Or would you recommend the other way around, go for something like a senior citizen savings scheme, Prime Minister Vaya Vandana, and do SIPs into equity? What would be your recommendation? And if you're suggesting the lump sum approach, should I wait, like you indicated a couple of times, right? Waiting for the LTP to come closer to something like a moving average. Would that be the time you would recommend entering if going via the lump sum approach? That's my only question, Shreyas. Thanks in advance.
See, with hi, bro. So, great question. See, with retirement savings, you never invest lump sum. First of all, the first thing you want to take care of when it comes to retirement savings is
Yeah,
ideally
they
your
have a
fixed.
monthly pension also. I forgot to mention that
Excellent.
they have a monthly pension, and 85% close to is invested in safe assets. So the 15% I'm trying to get some exposure into the equity side.
Excellent, excellent. So here's the thing. So once you're able to cover your their whatever annual expenses are there from whatever fixed income is there, they can just have for whatever they have over surplus, which is not they don't require that to be in fixed income, and they can afford to take some risk on it. They can have an SIP. You ideally what you do is you have a lump sum investment in debt, not in equity. You have a lump sum, even the portion of money that you want to put in equity, you invest that into debt. And as you said, you have a systematic transfer plan from debt to equity from that particular portfolio of debt, which is going towards risk assets. Because anyway, if you're covering whatever your expenses are there to your current fixed income, be that through rental or through pension or through so on and so forth, then you were like, okay, I can afford to take risk on some other things, and that you want to do through a SIP process. You don't want to do lump sum. There's no point in for somebody who's retired. There's no point in having a lump sum investment into equity. Just spread it over time. That's it.
Okay, thanks. Thanks, Shreyas.
Yeah.
Yeah, Varun, your question?
No, I just came here to say hi to Bandi sir. That's it.
Yeah, thank you. Rakesh, your
Hi, bro.
question?
Oh no, no, actually I wanted to have have some light thrown by him. Nowadays I am seeing many people on Quora, on Twitter, on everywhere wherever I see related to the stock market thing. So many new people 18 year, 19 year, 20 year, 18 to 25 mostly who who just got into college or who just got their first salary. They are putting their entire money in intraday F&O option trading and losing it all because they want to become big overnight. So they are losing it all. I just met a guy who said that he lost his fourth year's college fee, which was 3 lakhs. And I met another guy who said that he lost 2 years of his income, which was like 7 or 8 lakhs. He basically had 3.5 lakhs salary. He was staying at home, work from home. He saved every penny, invested it. I mean, he traded in an FNO and he lost it all, like in Adani Enterprises, just recently in the last 1 to 2 months. So I think there are many more people like them. So what can we do? Shall we can we do something like a trend in Twitter or something like please be careful with your money or something like that, because these financial the people, some they're like many of you might know, right? Some people on Twitter post that I got 10 lakh profit, 20 lakh profit, 30 lakh profit, but they don't post their capital. They might have a 20 or 30 crores, and that is just 1% for them. And people here who have 2 to 3 lakhs as their capital, they want to earn 10 lakhs in a day, which is not that which is close to impossible every day. So I think we should do something for them.
Okay, so here's my take on this. Okay, I appreciate the sentiment, but I'll be quite straight here. Somebody has to feed the market. Okay, and the way it works is it's a negative sum game. Effectively, among all traders, it's a negative outcome because we are paying brokers, government, exchange, so on and so forth. It's not about awareness. People don't lose money due to lack of awareness or lack of intellect. People lose money due to greed. Sometime back I had posted, I think 1.5 year back, some of the top, my mom's colleagues, she's a teacher. So her colleagues, teachers, they're from IITs and IIMs, some of them, right? All very brainy people, smart people, right? They fell for a Ponzi scheme where some guy was like, we're going to give you 2% per week interest, and all of them, they gave him some 1 lakh, then they got their money back, then they gave 5 lakhs and they got their money back, give 10 lakhs and the guy's gone and money's gone, everything's gone. It is greed. You can't change human nature. It's not lack of awareness that is leading to people saying that I'm going to bring 1 lakh to the market and I'm going to make it 1 crore. I'm sorry, if you lose money like that, you deserve to. And if you didn't do it here, you would have probably gone to Delton Royale in Goa and you would have lost it there instead, right? And if not, you would have given it to some guy who's saying, I'm going to give you 10% return per month, and you would have lost it there. If you are greedy, it is not, the problem is not awareness. Please get this like very straight. People who have to lose money by doing stupid things will lose money doing stupid things. If you come to the market thinking it's a casino and you play like that, you will lose, man. You can empty any account. It doesn't matter what size. And I'll tell you, it's always the same story. It's the guy who'll buy it at 50 rupees. It'll go down to 25. He'll buy at 25. It'll go down to 10. He'll buy at 10. It'll go down to 2. He'll say, now even if it comes to 4 rupees, I'll get my money back. You buy at 2 and then you're zero. Maybe 1-2 times he'll make money also. See what will happen? 1-2 times he would have done this martingale, and he would have come back and would have made money also. Like he would have been like, oh look, I've returned. I started with 10,000 rupees account. Now it is 25,000. But that 25,000 is a matter of time to become zero. So you can't help people who cannot help themselves. Unfortunately, ignorant. This is not ignorance. I would not even call this ignorant. If somebody is telling you that bank FD is giving 7% at this point of time and for 15 months and 1 day, and somebody is telling you I'll give you 10% in a month, and you give them your money or you try to trade like that, and you have to lose. Somebody has to feed the market. Let's not misunderstand. This is not some beautiful story where everyone wins and everyone's happy and everyone, happy. No, effectively among all the traders, money is reducing. The government is taking its chunk. The brokers are taking. Exchange is taking. Every Tom, Dick, and Harry you can take is taking, and you are thinking that you will say some awareness and people will get to know and they will not trade. And one more thing, right? This whole regulation part, like SEBI was like, oh, we will bring down leverage so that way people will not lose money. The only thing that it did, it reduced the returns of proper, seasoned, experienced, disciplined traders. It reduced their ROI because they can leverage less. But it has not done anything to reduce the fact that someone who's going to come with 1 lakh is going to lose that 1 lakh. If you buy like 100 shares of 1,000 rupee option, or like 1,000 shares of 100 rupee option with 1 lakh, hoping that it goes double and you double your money, and it halves, and then you add some more money, you borrow money. See, it's all gambling addiction. You think gambling addicts have a lack of logic? They don't have a lack of logic. Like, I don't know if you've ever seen a gambling addict, but I've unfortunately had the pleasure of seeing one who's like, okay, you made money one time and then you lost it all, but you think I'm some genius, so I have to make money because I'm special, right? And then you borrow money from somewhere, and you sell the stuff you have, assets at home, jewelry, you sell all that, and then you bring that to the market, you lose everything, right? You've destroyed all your relationship. It's very dirty. But don't think some awareness is going to help people. People who have to lose will lose, because it is not about whether they are using the correct techniques or correct setup. And it's not about any of that. If you're greedy, if you think you're special and you're going to bring 1 lakh and you're going to make 1 crore, I'm sorry, you're serving yourself up on a platter for some guy who's going to take that money from you. People are, trust me, we are the weakest participants in the market. Never forget that. When you sit at the desk, you have the weakest mentality, you have the weakest capital, you have the weakest execution, you have the weakest technology, analysis, research, weakest. Understand that you're the weakest participant. If you still think you can make some money in some structured way, go ahead. Otherwise, don't. There's no awareness. There's not lack of awareness. Trust me, it's not lack of awareness. The same Ponzi schemes that 100 years back people fell for, today also they're falling. Is it lack of awareness?
Yeah, yeah, it's greediness.
Yeah.
Yeah.
I
Suresh,
think
we'll
with
take the
that,
last.
Yeah.
we'll take last question and we'll call it.
We'll take
Yeah.
the last question and we'll wind up the session. Rakesh, your
Yeah.
question.
Hey, hi, Stace. Thanks for your time. So I just have one question. One is that I know that you did MBA and you worked as analyst. So let's say I want to understand how businesses, work from their balance fundamentally. I want to understand their, business sectors, balance sheet, So what would be the starting point? Just I was just thinking of, going through the curriculum of say, MBA finance from many reputed universities. So that's my first question. What would be the starting point, to be a fundamental investor? And second thing is that, uh, second question is that in your earlier commentary, you told that you advocated advocated for low cost ETFs. So the question related to that is that I have mutual funds in without any ETFs, mutual funds in large cap, small cap, one ELSS and one index fund. So should I redeem those and switch them to ETFs, or I mean, how do I go about it? Say I want to be participated in the ETFs. So yeah, so these are my two questions.
Sure, Rajesh, bro. Great. So, look, you don't need an MBA in finance to understand how companies work or how to read a balance sheet or how to understand ratios or to understand fundamentals. Let's literally fundamental analysis requires you to understand the metrics of the business. And the beauty of what YouTube has become today is literally if you Google how to read a balance sheet, how to understand, how to compare a company versus industry peers, what is a price expense ratio, what is EBITDA, what is what are all these different, there's 50 different ratios, right? What is how do these projections work, how do growth projections work, right? You can understand how to study a company fundamentally. You don't have to do an MBA finance for that. Anyway, I have a different take on why people do MBA finance, but that's a completely different story. We'll leave that for now. So fundamental analysis is nothing but you are trying to understand the core business of the company, how much capital it's putting up, how much return it's generating against that, how much its bottom line and top line are growing, how is it comparing versus its peers. And YouTube has amazing content for that. There are many channels. You can get it from there, how to study company fundamental analysis. As far as low cost ETFs, right? I'll just give you an example. Okay, let's say you invest 100 rupees in an ETF, and you invest 100 rupees in some PMS fund or some mutual fund. Let's say that mutual fund is charging you 2% per annum. Let's say market gives 12% return in the year. Your ETF has gone to 112 rupees, but your mutual fund has gone to 110 rupees because 2 rupees you've paid. Okay, fine, fair enough. Next year, let's say there's zero return. So your ETF stays at 112 rupees. Your mutual fund comes down to 108 rupees, right? One more year of zero return. So if you see, and this we just spoke about 2 years, but now you're talking about 12% return versus 8% return. If you project this over any period of time, simply by the fact that you're paying some guy because apparently he's some genius and he's going to pick stocks for you, 2% is way too much. You cannot afford to. You look at, people criticize me when I said, okay, Marcellus has never beaten a single benchmark of theirs, right? But now everyone's talking about I said this some 6 months back that in his entire life, that Marcellus PMS has never beaten its benchmark, whichever benchmark they've only put. I've not put random benchmark. On their own page, you can see that every fund of theirs has beaten, but the guy can talk very well, so he will get huge amounts of investments. As an investor, always think about if you can buy the same thing, if you can buy 1 kg gold for 100 rupees, why will you buy it for 102 rupees? Why do you want to pay more? So as an investor, you're thinking about, I want to buy quality. I'm not buying cheap stuff. I'm buying the same stuff, but I'm buying it for cheaper. And while this 1.5%, 2%, 2.5% charges don't seem like much, if you see over any period of time, they can eat into 50, 60, 70% of your returns over a period of like 10 years plus. They can eat 50, 60%. Now, you're paying 50, 60% of your earning essentially to some dude because you think he can pick stocks. Nobody can pick stocks. Some people get lucky, some people can pick moderately decent stock, but the benchmark will always do fine. So if you are already invested in mutual funds and you have a considerable sum, provided you don't come under short-term capital gains and it's long-term capital gains, you just look at if it's a high charge. If it's a low charge, if it's low cost, it doesn't matter. If the cost is 0.3, 0.4%, it's okay, fine. But when ETF is giving you at basically 0.1% type cost structure, why should you be paying somebody else that additional 1.9%? You can own the same companies as the benchmark. Then you say, okay, I will have Nifty Bs, I will have Junior Bs. If I want to put in IT, I'll put IT Bs. If I want to put in banks, I'll put in bank Bs. I'll manage my allocation such that 70 to 80% of my capital is in large cap stocks, good stocks, and then the other 20% do whatever you want, like, buy small caps and all that. And maybe you can say that 5% of my portfolio I'll put into micro cap. Who knows? Maybe I might get 10x, 20x, 30x, or it might go to zero. Right? So do stuff like that. Mutual funds, just the charge structure. See, what is my problem with Martians when I posted about it a long time back? Is that, and the Mint also covered me. They said I am trolling. I'm not trolling. The fact is, this PMS has never beaten its own benchmark. So for what are you paying 2%? You're not beating benchmark. On top of that, 2%. It makes zero sense to me. These PMSs, right? They have a structure. It's either a fixed amount, like 1.5% and 2% plus 10% of whatever they make, or it's a flat fee of 2.5%, stuff like that. It's just you're paying for, I don't know what you're paying. If you want to make wealth, low cost. Think of how you can buy the same bar of gold, because you're not getting some special bar of gold. You're getting the same bar of gold. Just use ETFs. I think
Okay.
that's good. Yeah,
I
I
hope
think we can.
I hope
Yeah,
all your questions got
Shreyas,
answered.
just an ending question I would like to ask you. What's your, let's say someone short Adani, what would be your price target for that?
I don't even open Adani chat, bro. I don't want to look at something I don't plan to touch.
And
See, I'm telling you, life is about draw your boundaries. Draw your boundaries. I know what I'm doing. I'm not going to go randomly just for chill's sake, think about how either short karunga, either ye karunga. It's not my core competency, and I don't want to get into that. See, you always start doubting yourself, feeling anxious, feeling this thing when you do something outside your core competency. Build very niche, very specific core competencies and stick to only that. Think about, okay, is there a chance to build competency elsewhere around? But see, my main issue with something like Adani is it's a bomb. It can go either. You might make huge money, you might lose huge money. I don't want to do that. And I don't want to distract myself. I can think, okay, with 1% of my account, I can take a position, but that's a distraction for me. That's distracting me from what I do generally. Right? I don't want to look at it. I don't want to,
understood.
it's like
Yeah.
blinkers, horse blinkers.
Yeah.
So that's that. Thank you so much, everyone, for joining. This was basically had nothing to do during the market, so we thought this thing. Thank you all so much for joining. Thank you guys for helping me host it. Mohit, Krish, and everybody else. I see a lot of my friends in chat as well. Thanks, guys, for joining in. And I'll probably try and do this probably next month when there's nothing going on. But yeah, this was impromptu and it was a lot of fun. Thank you for joining me. I think we'll just end it there.
There's one request. Please start uploading YouTube videos. It helps to learn.
Akshay, we were unable to hear you. Can you just tell me again?
जस्ट वन रिक्वेस्ट श्रेयस भाई, आप जब पहले यूट्यूब पे वीडियो अपलोड करते हैं ना, वो लर्निंग के लिए बहुत हेल्प करता है, तो आप प्लीज उसको कंटिन्यू रखिए.
I think भाई जो भी कहना था I think वो हो चुका है. उससे the problem for me is I lack motivation to do something where I feel that I'm not adding incremental value. मैं करूंगा नहीं उसको. If I feel like I'm adding value, उसमें कुछ है बस करने के लिए करना चाहिए. I never had any intention मतलब YouTube से कुछ होगा ये that and all. I wanted to do it because it was something I was driven towards, and now that motivation is not there. But we'll think of other things. We'll think of stuff like what we did today with spaces and stuff like that. So yeah, thank you all so much. Have a great day, and wish you all the best with all your trades, and be careful till the budget. Take care. Have a nice day. Bye.
Thank you, Shreyas.